Have you ever wondered why some companies thrive while others fail, despite having the same opportunities? The secret often lies in one critical factor: corporate governance. In today's video, I'll break down how corporate governance directly impacts a firm's performance, profitability, and even stock prices. Whether you're an investor, entrepreneur, or just someone interested in finance, this video will help you understand how companies are really managed behind the scenes. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It determines how decisions are made, who has power, and how accountability is maintained. The key players: the board of directors, management, shareholders, and regulatory bodies. Think of it like a car. If the leadership is the engine, corporate governance is the GPS that ensures the company stays on the right track. Now let's talk about why corporate governance is so crucial for firm performance. Studies have shown that companies with strong governance experience higher profitability, have lower financial risks, gain investor trust, and are less likely to engage in fraud. Take Enron, for example, one of the biggest corporate scandals in history. Poor governance led to unethical financial practices, which ultimately resulted in bankruptcy. On the flip side, companies like Apple and Microsoft thrive because they have strong governance structures in place. So what makes corporate governance good? Here are the key elements: transparency, accountability, fairness, and responsibility. Transparency means clear financial reporting and disclosure of company performance. Accountability involves holding executives responsible for their decisions. Fairness entails treating shareholders and stakeholders equitably. Responsibility covers ethical decision-making and risk management. When a company follows these principles, it builds a reputation of trust, attracting more investors and customers. Investors love companies with strong governance. Why? Because it reduces the risk of financial scandals, mismanagement, and fraud. Studies show that firms with good governance often have higher stock prices and lower volatility. For example, Warren Buffett, one of the greatest investors of all time, heavily considers corporate governance before investing. He avoids companies with poor governance even if they have high profits in the short term. Governments and financial institutions also play a role in corporate governance. Organizations like the SEC, Securities and Exchange Commission, and corporate laws ensure companies follow ethical practices. Regulations like the Sarbanes-Oxley Act were introduced after financial scandals to prevent corporate fraud and protect investors. Without these regulations, companies could manipulate financial statements and mislead investors. In emerging markets, corporate governance is even more critical. Many companies in developing economies struggle with weak regulations, leading to corruption and financial instability. However, firms that adopt strong governance principles often attract more foreign investment and experience sustainable growth. A great example is India's Tata Group, known for its ethical business practices. Strong governance has helped them expand globally and build a solid reputation. So, what does this mean for you? If you're an investor, always research a company's governance structure before investing. Look at the composition of the board of directors, transparency in financial reporting, history of ethical practices, and shareholder rights and treatment. By focusing on these factors, you can make smarter investment decisions and avoid risky stocks. In summary, corporate governance isn't just a boring business term, it's a powerful force that shapes a company's success. Strong governance leads to better decision-making, higher profits, and safer investments. If you found this video helpful, make sure to like, subscribe, and hit the bell icon for more finance insights. Drop a comment below. Which company do you think has the best corporate governance? Let's discuss.